Welcome, ladies and gentlemen, to a new edition of Commodity TV here out of our studios in Switzerland. And it's my honor and pleasure to have here Jorge Ganosa, the co-founder and CEO of Fortuna Silver Mines. And yeah, great producer, gold, silver, but also lead and zinc. And the company is running on 2 continents in 6 countries, their mines. Jorge, great to have you here. Thanks for taking the time.
Thank you for the opportunity.
Yeah, I'm a shareholder in the company. I want to disclose this, of course, upfront. I must say I'm very impressed by your company and what you have done in the last year. It's almost 20 years, I think, your company is now online. And maybe let's talk about the last year. I think that was not too bad. You were quite satisfied, I could imagine.
Last year, we achieved a milestone for the company. We brought into production our flagship asset, Séguéla, in Côte d'Ivoire, the Ivory Coast. We delivered on the back of that 450,000 ounces of gold. That's a gold equivalent. And, in the second half of the year, the business was running on all cylinders, I say. We generated $70 million of free cash flow from ongoing operations in the third quarter. $66 million in the fourth quarter. We broke our record in terms of quarterly production in the fourth quarter with 136,000 ounces of gold. And that was just the beginning of all that performance was pushed by the new mine coming into production. First gold at Séguéla was poured in May of 2023. And we exited 2023 doing 27-30% better than nameplate capacity at the processing facility. So, we have meaningful production, competitive cost, and the business is just doing great. We're looking at potentially this year at 480,000 ounces of gold, getting closer to the 500,000 ounces of gold of annual production. And at these prices, looking to generate revenues of close to $1 billion.
I would say it makes much more fun than it was last year. Definitely. So that sounds like a very healthy organic growth. We said already you are running 6 mines now.
5.
5 mines, but the 6 is, let's say, on the path. Exactly. Let's talk about that, because I think that is the future of the company, the immediate future.
We have 2 levers for growth in the property portfolio. And to talk about that, let me tell you that this year we're investing over $41 million in exploration across the portfolio. That funds over 200,000 meters of drilling. And we see growth coming out of our Séguéla mine, the new mine, but which continues to offer discovery opportunities. About a month ago, we announced the emergence of a new prospect we named Kingfisher. It's still early days, but we're making discoveries in the property. And then the other one is Diamba Sud in Senegal. There we made an acquisition last year, Chesser Resources, an Australian listed company. And with Chesser, we acquired a project with a historic resource of about 850,000 ounces. We made the acquisition in September, we closed it, and in November we had 3 drill rigs drilling the property, right? And we want to enhance our knowledge of the ore body, expand it, and we see Diamba as potentially our new development project. Today we view it as advanced stage exploration. It is we want to see it grow beyond 1 million ounces in resources. And we're doing the work to see if we can get there, right?
Fantastic. Are you also planning maybe to start with a PEA, something like that? Because it sounds to me like this is definitely the next mine.
Chesser did a lot of engineering work. But again, we're not treating it yet as a development stage project. We're treating it as an advanced exploration project. And I repeat that the expectation is that we can carry the work this year and see if we can cross the threshold of 1 million ounces. We believe there is potential for that.
Okay, super. You just had also an interesting press release, I think it was 1 or 2 days ago, about your mine in Mexico. Why was that so significant?
Yes, our Mexican mine, San Jose, has been a pillar in our portfolio for many years. And right now it's coming to the end of its reserves. We're exhausting reserves in 2024. But how this business is, we made a discovery in August, September of last year. It's called the Yesi vein. It's been a very exciting discovery because it's high grade, very close to existing mine infrastructure, so we can easily develop it. It's in an area where we don't require new permits. So we have access to surface and readily accessible from the underground with a bit of development. And we're currently drilling with 3 rigs, trying to go from an exciting an exciting discovery into an exciting resource, right? That we can plug into our life of mine plans. So we announced results for our ongoing drilling program. The headline of the press release was about a kilo of silver over 8 meters of width. And those are the kind of grades and intercepts that we're hitting. So we're quite excited about it. But we still need more work to see if this discovery matures into also a high-grade resource that can feed the mine plan, right? We still need more work. I'm confident that by mid-year, second half of the year, we'll be in a position to start looking at a resource here, right?
Okay. If I look at your presentation, it seems to me a little bit like that your stock is still very undervalued. What do you think might be reasons for that? Is it because you are more in Africa? Is it because some of your mines have a shorter life of mine? Or is it a combination out of it? What is your feeling?
Well, I think the short life of mines have been discounted, right? That are properly, we communicate transparently, those things have been discounted. And yes, our move to West Africa back in 2021 was quite controversial, and investors had some legitimate concerns at the time. A company that had been so successful in Latin America building its business, the questions were, are these guys going to be as successful in a new jurisdiction, West Africa? Is Fortuna going to be able to integrate successfully the West African business? And not only that, attached to the acquisition, we had a development project. So at a time when investors were very risk averse and there was a lot of apathy with respect to mining equities, we not only did an aggressive acquisition, we also had to do a capital project. Well, watch and see, no? So we did a successful integration. And we delivered a successful construction on time, on budget. And in a way, we were counter-cyclical because right now, with this surge in precious metals, we're at a time of harvest, right?
That's good.
So our share price has been re-rating this year. Year to date, our shares are up 25%. We're beating the index, GDX, and performing over our peers year to date. February to date, I think we're up like 40%. But we still believe there is room for if we look at our price to cash flow multiples, enterprise value or EBITDA, we still see ourselves discounted with respect to some of our peers. And I believe that, cash is king, and we're generating a lot of cash. In the third quarter, as I mentioned, we generated $70 million of free cash flow from operations. In the fourth quarter, 66. And, the business is performing really well. We're generating cash.
Yeah. That raises the question, what do you want to do with the cash? I think you paid back also some debt, right? Which I like personally, because it takes off the risk.
We are not a highly debt-leveraged company. Our debt to EBITDA ratio travels at around 0.2 today, 0.3. So, having said that, we believe that a mining company needs to have a fortress balance sheet. And these are the times with rising prices when you put that fortress balance sheet together, right? And so we paid in the third quarter of last year, $40 million. We followed in the fourth quarter of 2023 with a $41 million payment. Wow. And this first quarter of 2024, we followed again with another $40 million payment towards our credit facility, which currently stands at about $130 million.
Our net debt in the bank?
Our net debt position is currently 85.
So you have 50 million in the bank.
Yeah. And more importantly, we reinitiated our share buyback program in Q1. We bought back about 1 million shares. And there was a royalty, a net smelter return royalty on our Séguéla property with Franco-Nevada. And we bought back half of that royalty. We had a buyback right, and we exercised the right. That was about a 10 million Australian dollars payment. So the business is generating very healthy cash flows, and we're deploying the cash flows towards debt reduction, share buybacks, enhancing the economics of the projects for us by, buying back the royalty. It was a 1.2% royalty. Now it's down to 0.6 because we bought 50% of it. And more importantly, funding exploration across the portfolio. We have a $41 million budget, 200,000 meters of drilling, and that's where the money is going.
Okay, super. Where do you want to have the company positioned in the next, let's say, 3 to 5 years? What would be on your dream wish list, whatever you want to call it?
Yeah, I think you should expect to see Fortuna consolidated as a mid-sized producer with industry-leading costs at or below the average for the industry. Today, the average AISIN for the industry travels at around $1,400 per ounce. No? In 2024, we have guided around $1,550 per ounce for the AISIN, and I believe we have the opportunity to bring that down into 2025 and onwards. So I want to consolidate Fortuna as a mid-sized producer in the range of 500,000 ounces annually with industry-leading costs and reserve lives 18 to 10 years or more, right? And that's something that is not an aspiration for the future. It's something we've been working on for a number of years now. Or Lindero mine in Argentina has over a decade in reserves. Last year performed at $1,500 per ounce. This year, if we adjust for one-time capital projects, it's also a mine that should perform in $1,400 to $1,500. Or Lindero or Séguéla mine in Côte d'Ivoire, the one you just talked about, close to a decade in reserves, $1,100, $1,200 per ounce AISIN. No, Diamba Sud in Senegal, it's a project that offers opportunity for that. So that's what we want to do with the portfolio. Not necessarily bigger, but a well-established mid-sized producer with industry-leading cost and good, predictable life of reserves.
So let's say growth is nice, but it has to be quality growth with good margin.
Absolutely.
Maintain the margin, right?
We, in this environment of surging prices, we as stewards of mining companies need to keep discipline. Keep a lid on cost. And sometimes in a surging environment for commodity prices, we are under pressure to just show growth and develop deposits that sometimes shouldn't be developed. It's time to strengthen the balance sheet. It's time to focus on keeping a lid on cost so we preserve margins as prices surge, right? And that's what we are focused on.
I like it. I know why I'm a shareholder. Jorge, thank you very much for that. I would say please keep it going. Bring Séguéla in production, of course. And it is already Diamba. Sorry, those names are sometimes funny. But bring it in production, please. And I would say let it run at San Jose, because my feeling is with those veins you have just discovered, that looks quite good. And we take it from there.
Perfect. Thank you for the opportunity.
Thank you very much. Thank you. Yeah, ladies and gentlemen, that was Jorge Ganosa, the CEO and co-founder of Fortuna Silver Mines. Yeah, you heard it. The company is in extremely good shape. And what I really like is the conservative approach the management has. No adventures. They love to grow organically. That's the first thing. The second thing is margin is key. Not only growth. And you know me, I like margin more than anything else, because this is how you maintain a business long term. And also I like the idea to say, okay, listen guys, we have to look here to balance in the next 3 to 5 years the costs and also the mine life of the mines, and probably some new stuff here, and huge exploration potential, but also they do really exploration, and they had a very, very good success already this year. And financial stability. This is exactly what a company has. I mean, a net debt of approximately $85 million for such a size of a company, that is outstanding, and this is what we like. So Lot of future potential. Don't forget, in the chart, the price has broken out already at $6.50. That looks really good. Our first price target is $9.5 Canadian dollars, and afterwards followed by $15.5 Canadian dollars. And I just want to give you one little mathematic. 460,000 ounces production. Now at $2,300, $2,400, you can imagine what that means for the margins when they want to bring down the costs further to approximately the $1,400 level. So I think the stock is very undervalued. Check it out. Thanks for watching us, and bye-bye from Switzerland.